All right, good morning, everybody, and welcome to another Mortgage Coach educational event. Every Tuesday, 9 o'clock Pacific, we are here to bring value to you. I'm always looking for great authors, great speakers, top producers that are killing it in the market today. And today we have Jason Hartman. What's up, Jason?
Hey, Dave, it's good to be back and crazy times we are living in, that's for sure.
There is no doubt about that,
Yeah,
man.
it's when we look back at this time in history, I don't know what we're all going to think, but hey, big news since I was on with you last, I was able to get a haircut.
Yeah, right?
And I think they overdid it, but hey, it'll grow back. Hopefully
I
the
still have
economy will grow back too.
yeah, no, I still have a few buddies that have not figured out a way to get a haircut, and
Yeah,
you know who you are on today's call.
yeah.
And if this is just your new look, it's all good with me, man. I'll get used to it. So, so guys, last time I interviewed Jason, I think the headline was investing in real estate in a pandemic, and he had incredible slides. I'll put a link down below to the last interview that we did. But I think you not only made a case for investing in real estate, you talked about some of the bigger trends that are impacting, that are just different. I mean, like
Yeah.
after COVID, how people buy real estate, how people invest in real estate, it's going to be different. Anything you want to add to that before we get into today's topic?
Oh gosh, there's so much. It's hard to pick a topic, but certainly we are seeing that from what I said last time, that the home is the center of the universe. Probably everybody watching now is experiencing phenomenal business because there is a mega refi boom and just a mega purchase boom going on. Some of that is pent up demand, so don't count on it lasting forever. I think the economy is very sick in a lot of ways. So it's hard to accuse me of being too much of an optimist, but there are definitely opportunities at the same time. Last time, I think I mentioned that Chinese symbol for crisis, which is the same as the symbol for opportunity. And it literally means crisis is an opportunity riding the dangerous wind. So it's kind of interesting there. And there are definitely a lot of opportunities in this time of crisis. But hopefully with your listeners and viewers today, Dave, we'll be able to suss some of them out for them so they can position themselves to be in the right place at the right time. And it is a time where things are changing quickly, and we've all got to be very careful and be very aware. Connections are key right now. Education is key. Listening to the right people is key. If you're listening to the mainstream media, you're probably not listening to the right people. You got to be listening to niche media that addresses your industry, like what Dave does here with a mortgage coach. And what I do with my investor clients, and we help people invest nationwide in properties. Yeah, we take a deep dive into economic issues and things like that. And today, Dave, what I wanted to share is a technique that I've been teaching for 16 years now called Refi Till You Die. I figured your audience, especially being mostly mortgage professionals, would really love hearing some of this stuff. So I'm ready whenever you are. But if you've got some questions for me to start, happy to take some questions.
Yeah, well, first of all, community, I give you guys the first shot. If you're watching this in Zoom and you have questions, put them in chat. If you're watching this in Facebook Live, put them in comments. Whether I get them at the front end of the call or the back end, we will have some time for Q&A. So anybody who missed the last time, I met Jason, I mean, I think it was over 20 years ago, before I founded Mortgage Coach, and he was a top producing realtor in Irvine, California. Just up and comer, killing it. And then he's become a real estate investor, has built a large community, nationwide community of real estate investors. He's got a podcast, he invests in real estate, and he helps people build wealth with real estate. So today's call is going to be building wealth with real estate, Jason Hartman's Refi Till You Die strategy. And I think there's just some power in the headline itself. I always advocate that if you're a local referral-based mortgage professional, you need to bring value beyond the transaction. Let's face it, big banks can do a predictable transaction, and they have really cheap jumbo money. Online lenders can provide a great rate on a mortgage transaction. If you want to thrive and kill it, and not worry about whether or not Quicken is going public, not worry about whether Zillow is getting in the mortgage business, not worried about the disruptors like Redfin and how much money they're raising and how many resources they have. You need to bring value beyond the transaction. And so I think what you're going to hear in today's call would be a great lunch and learn for realtors. Like, you may want to take some of the content, some of the slides, some of the insights that he's going to share, and bring them into a lunch and learn with agents and help guys build wealth with real estate. And this strategy today is with the Refi Till-Ya Die strategy. So Jason, unless there's anything else you want to frame the call around or anything else you want to say about yourself, let's get into it.
No, I think that's great. And yes, we did meet an awfully long time ago. And I remember when I used to use the Mortgage Coach software, I had a couple of mortgages businesses, but I was always mainly in the real estate brokerage side. And it's just great to really be able to be that value added resource for our clients. And that's you know, what everybody watching right now definitely wants to do. And that's good. Like you said, you know, you don't have to worry about the competition. You don't have to worry about, you know, Quicken Loans or whatever, or Zillow. You know, all these companies are going to do their thing. But if we provide the maximum value to our clients, we're going to have those clients for life. So that's very good philosophy. So let me go ahead and share my screen here, and hopefully you'll be able to.
I'll tell you when I see it.
Okay.
Remember, guys, if you have questions, put them down below. Jason did let me know that he is going to share these slides with us. So after the call today, we will be putting these in comments. And Phyllis, thank you for the question that you just posted. I like it, and I'll make sure I ask that at the next opening. So Jason, we see your slide, we see your screen.
Yeah, you see it, but it's kind of weird. Yeah, let me fix that. Let me see if I can fix that here. This is how it all goes here, folks. How's that looking? I'm looking at it in your Facebook group as well.
Boom.
So
yeah, no, that looks great. Let's rock it out.
Okay. All right. Cool. Okay, cool. So good stuff. So I'll just kind of go through this. And you know, one of the things we do is we really teach our investors the importance of maintaining control. And I have these 10 commandments for successful investing I talk about a lot. And one of them is thou shalt maintain control. And one of the reasons we think this is so important, Dave, is because when you relinquish control of your investment to somebody else, a financial planner, a Wall Street firm, you know, we're all around the most historically proven asset class in world history. That's income property. It's real estate, okay? And that's what we should be focusing on and helping our clients focus on that too. And, you know, when we invest in real estate, we're a direct investor. You know, we decide what to buy, where to buy, when to buy, you know, how to finance it, when to refinance it, when to sell it, when to do a 1031 tax deferred exchange, whatever. We're in control. So there's no middleman that can really rip us off very easily, okay? When we relinquish control by being a non-direct investor, when we invest with Wall Street, for example, we leave ourselves susceptible to three major problems. The number one problem is we might be investing with a crook, okay? And we've all heard about Bernie Madoff and Enron and WorldCom and Global Crossing and now Wirecard and all of the rest, right? The scandals on Wall Street are relentless. They're just, it's an everyday occurrence practically. So we want to avoid that. We want to control and buy our own investments that we control. Number two problem is you might be investing with an idiot, okay? And you'll lose money just because of the sheer stupidity of the person you invest with, right? And so you don't want to do that. You want to invest with yourself. Be a direct investor, right? So own properties and control them directly, okay? And number three, assuming they're honest and competent, they take a very large management fee off the top for managing the deal. So be a direct investor. Be a direct investor, okay? And so, you know, that's one of the things that's really resonated with a lot of our clients very well. I talked, last time we talked, I think I talked a little bit about inflation and the the realistic possibility of that continuing in the future and how the US might get out of this problem. I won't go into that today so much, but I did talk about the way inflation transfers wealth from lenders to borrowers and from old to young, okay? And so we won't go into that too much today either. And again, all of this stuff is available on my podcast, my website, my YouTube channel, et cetera, et cetera. And suffice it to say, though, I show a chart, and this is available on my YouTube channel as well, where I basically show people how inflation basically pays us to borrow money. We basically get paid to borrow money. And by the way, I'm waiting for the Facebook group to catch up with the slides I see. It's a little different. So pardon me if my speech is a little bit out of sync with that. When you're simulcasting like this, it doesn't always
Jason,
happen
just so you know,
Uh-huh.
when you watch it on Facebook,
Uh-huh.
the slides are lagging, but so is your voice. So
Got it.
everything they're hearing is a few seconds behind. So everybody
Okay.
should be getting it as, however they're
Perfect.
consuming the content.
Perfect. That's good to know. Good to know. So anyway, suffice it to say, people essentially get paid to borrow money, especially now. And that is the beautiful thing about what you do as mortgage professionals. Okay, you allow people to take advantage of what are realistically zero interest rates, or actually negative interest rates. Because if you take the real cost of inflation, remember, inflation devalues our savings account, our spending money, our stocks, our bonds, but also, thankfully, it devalues our debt. Inflation literally pays debts back for us. And since real estate is the most tax-favored asset class in America, we get the benefit when we borrow money of taxes and inflation that essentially pay back our mortgages for us. And this is the hidden wealth creator that a lot of people don't see when it comes to real estate or with income property, but they get the advantage of it even if they don't really understand it. So one of the questions I get asked once in a while, and why I show the picture here of Jerry Maguire, Tom Cruise's Jerry Maguire, is because he said the famous line in that movie, "Show me the money, show me the money." So essentially, the strategy I'm about to share with you, I dubbed this 16 years ago, I dubbed it Refi Till You Die. And it's a trademark strategy that tells us how to extract the wealth from our income property portfolio in the most tax efficient way and the most wealth creation efficient way. The old fashioned way that really did work well before 1971, before Nixon, President Nixon at the time, closed the gold window and basically completely detached the US dollar from its convertibility to gold in 1971. That's when everything changed, the game changed. And sadly, a lot of people are still following these old-fashioned rules that did work very well before 1971, but have not worked very well since then. And what they've done is they've followed the old strategy that my mother follows, that my grandparents had followed, that was, the idea of pay off your mortgage, don't have debt. And that was a great strategy until things changed and money became completely fiat and not detached to a measuring stick like gold. Okay, and it didn't have to be gold. Gold is just the old-fashioned measuring stick that's been pretty consistent for 5,000 years. Okay, and by the way, I should say I'm not a gold bug. Okay, because I don't think gold is a very good asset class because it's one-dimensional, whereas income property is a beautiful asset class because it's multi-dimensional. In other words, we earn our return on our income properties in many, many ways, not just the strategy that precious metals offers or non-dividend paying stocks offer, which is buy low, sell high. Okay, we earn our wealth with income property in many ways. So buy low, sell high, get cash flow, get tax benefits, get leverage, get what I call inflation-induced debt destruction, which I've alluded to here, and more on the last episode here on the Mortgage Coach, and on my YouTube channel and podcast. You can find out more about this stuff because this could go on for many hours and we don't have that much time. So let me just take you through one strategy, just one of many, I call Refi Till You Die. Now for this strategy, I'm going to use the following example you see on the screen, which is essentially buy 10 inexpensive rental properties in diverse markets. If you came to our firm, we would tell you to buy 10 properties. Maybe they'd be $100,000 each, and you would diversify those in 3 different markets, 3 different cities, because you want to diversify so that you can have a more conservative asset protection strategy. Okay, there's an old saying in real estate: all real estate is local. In a country as large and diverse as the United States, there is no such thing as a national housing market. So when you hear these talking heads on CNBC, or you open the good old-fashioned newspaper, or you're reading something online, or you're looking at any mainstream national media, and they talk about the quote housing market unquote, or the real estate market, you have to ask yourself the question, where is the real estate market in the United States? Would it be in LA, Miami, New York, Chicago, Indianapolis, Memphis, Little Rock, Atlanta, Jacksonville, Florida? I don't know. In the US, the reality is there's about 400 real estate markets. It's a huge, diverse country. Okay, so we like these really conservative linear real estate markets. They're pretty boring, but boy, they can make you a lot of money. They can really help you create wealth. So properties, we'll just round off for the sake of example to make it easy. $100,000 properties, 10 of those properties in 3 markets with 20% down. So you need about $200,000 down payment. And maybe your closing costs are around 3.5%. And you need reserves, cash reserves, because things don't go perfectly. There are always vacancies. There might be maintenance issues depending on whether these properties are new or resale, or how extensive the renovation was on that property before you bought it. So we're going to say that to acquire this portfolio of properties, you need about $275,000. $200,000 down, $35,000 in closing costs. Of course, that depends on the mortgage you choose and whether you buy the rate down or not, or whatever, right? You all understand that. And then 4% of the value of the portfolio in cash reserves in the bank for problems and unexpected contingencies. So $1 million portfolio, $40,000 in reserves. Okay, so that's where we start. We bought this 10 property portfolio for $235,000 with $40,000 in the bank. Now, how does it start? Okay, the Refi Till You Die plan. Looking at the chart, we've got a $1 million portfolio, and I'll just put my mouse over there. We've invested $235,000. We've got $800,000 in mortgages and $200,000 in equity. This is how we start today. Now, there's something you've all heard of called the rule of 72s. And the rule of 72s basically talks about the doubling. And at an average annualized appreciation rate, and by the way, I should say, because I talked about income property being this beautiful multi-dimensional asset class, right? But in this example, we're only going to talk about one of those dimensions, only one, appreciation. That's just one dimension. So if you talk to any expert and you look back in history and you look at the nationwide appreciation rate for real estate, you'll discover that most people will agree that it's about 6% annually. Now, I know if you live where Dave and I used to live in Orange County, California, a high-flying cyclical market, when Orange County goes up, it goes through the roof, okay? And when it goes down, it suffers pretty badly, okay? That's a cyclical market. LA, the west coast of the US, Seattle, South Florida, Miami area, the expensive northeastern markets, New York, Washington, D.C., Boston, those would all be cyclical markets, like where Dave and I used to live in Orange County, okay? And the rest of the country, though, is either considered a linear market or a hybrid market. And we like the really boring linear markets. And if you want to see what these markets are, just go to my website, jasonhartman.com, click on the properties page, and you'll see a whole bunch of linear, boring markets where you can buy good rental properties for, $100, $130, $150,000, okay? And that's what we're talking about here. So this is how we start. We've got these 10 properties in this portfolio. And then what we do is we wait for the rule of 72s. Now let's start out and let's say we're 40 years old, 40 years young actually, because 40 today is the new 25, okay? and so we're 40 years old when we start our portfolio and we buy these 10 properties. We wait 12 years, okay? And the portfolio doubles in value. So that $1 million portfolio is now worth $2 million. Again, this is pretty slow and conservative and boring, but I promise you it's going to get a lot less boring in a moment. Just follow along. Okay, so now we're 52 years young, okay, and 52 is the new 32. And so that $1 million portfolio is now worth $2 million. We've had a $1 million gain. We go to the bank or we go to our mortgage coach professional and we say, I would like to refi my portfolio of investment properties, of rental properties. And so the lender says, sure, we'll give you an 80% cash out refi. Now, of course, this will change over time. Sometimes it'll be harder to get an 80% cash out. Sometimes it'll be easier. Hey, I remember back in the day when I knew Dave and I was living in Newport Coast, California, and I don't know exactly where he lived, but probably in Irvine or Newport, I guess, Dave, maybe you can chime in. And there were people offering, I couldn't believe it, but some of you who've been in the industry a while, not 120%, not 125%, 135% cash out refis. Yes, that actually happened. Not saying it was a good thing. It was pretty imprudent on the lender's part, but it was out there. Okay, so we go to the bank and we say 85% loan to value refi, give me $1.6 million in loans on my $2 million portfolio. My equity position has now doubled. I now have $400,000 in equity. I started out with $200,000 and I have $800,000 cash. Now, let's say I'm a terrible investor. I don't invest that money. I take the $800,000 and I stick it under my mattress or in a safe deposit box. It earns 0% return. And I just take 1/12 of that money. And remember, it's borrowed money, so it's tax-free. There's no tax on borrowed money. If I was to sell my portfolio of properties and not do a 1031 tax deferred exchange, I would pay taxes on my gain and my depreciation recapture. But I'm not selling, I'm doing refi till you die. So I take, and now I've got $67,000 per year tax-free to spend. Okay, now of course, being a smart investor, I'm going to invest this money, buy more income properties, earn a return off these investments. But let's just, for simplicity's sake, say it's not invested. I just take my $67,000 a year tax-free, okay? And I wait another 12 years. Now I'm 64 years young, And by that time, 64 will be the new 40. And I've now got a portfolio that has doubled again. It's now my $2 million, my 1 million went to 2 million, that went to 4 million. I've got a $3 million gain. I go to my lender and I say, hey, you taught me this strategy years ago and I love it. And by the way, I don't just have this portfolio, I've bought a bunch of other rental properties in the meantime. But let's just use this 10 properties to keep it consistent. I say, hey, will you give me an 80% cash out refi? And they say, sure. Here's $3.2 million in loans. Your equity position has now doubled. Again, you've got $800,000 in equity. You've got $1.6 million cash out. If you stick that under your mattress for 12 years and simply withdraw $133,000 per year, tax-free, that, depending on what your tax bracket is, that'd be worth approximately $200,000 in taxable money. You've got that $133,000 per year, and you still own the portfolio. You haven't sold anything, and your equity position keeps doubling, and your rents keep going up every year. Now, a lot of people ask, well, Jason, there's a flaw in your theory. I keep increasing my loan balance, so I've got higher mortgage payments. True, but not really true in real dollars. And here's why. Number one, inflation has diminished the value of those monthly mortgage payments over time, and the rent keeps going up. Now, is that guaranteed? Of course not. But historically, of course the rents go up. Look, if any investor is going to invest in providing housing, rental housing in the future, 12 years from now, 24 years from now, if they're going to make the decision to buy a property and create rental housing for a renter, they're going to think, well, does it pencil out? And of course, it's going to have to pencil out, or they're simply not going to do the deal. They're not going to buy the property. So that's your safeguard to know that the rents will go up. They certainly always have historically, and the inflation has always diminished the value of the mortgage payment and the mortgage balance historically. We know that's always been true, those things, right? But also, it's fair to say, well, hey, Jason, on the other side of your equation, won't inflation diminish the value of the cash out refi proceeds? Yes, it will. So you have to adjust for inflation on all things, on all counts. The benefits you get from inflation are inflation-induced debt destruction, destroying, in a good way, the value of your mortgage, your monthly mortgage payment, and the cash out proceeds as well. Okay? Inflation treats those all equally. Or does it? No, not really. And here's why. Since we lever our properties on a 4-to-1 or a 5-to-1 ratio, because we only put 20% down and the bank pays for the rest of the portfolio. In this example, we put $200,000 down to get a $1 million portfolio. Inflation benefits us disproportionately as investors because we only have 1/5 of the money in the game. This is the beauty. I mean, it's one of the many beauties of income property. And it's why we all know so many people who have become very wealthy owning income property. And again, I know I'm going a little fast in the interest of time. So if you want to understand more, because there's a lot more to it, about what I call IIDD, inflation-induced debt destruction, listen to my podcast, go to my YouTube channel where you can get full detail on that, okay? Because I have to pass through it a little bit quickly here to teach you the refi till you die strategy, all right? Okay, so now for the next 12 years, we're living on 133,000 tax-free dollars. There's no tax on borrowed money. Okay, so we would have to earn at our job or in our business maybe $200,000 or $220,000 to equal that 133,000 tax-free dollars that we borrowed, because there's no tax on borrowed money. Okay, so let's go one more round with this. Okay, let's let another 12 years go by. Our portfolio has doubled in value again. It's now worth $8 million. We've got a $7 million gain, okay? And we go to the bank and say, refinance me on an 80% loan to value ratio. And I've literally got to move my laptop screen out of my big screen here to see what I'm telling you. So we've got a $6.4 million gain. And our equity position has doubled again. Now we've got $1.6 million in equity, if you see where my mouse is. And we've got $3.2 million in cash out proceeds, which is $250,000 per year, tax-free, $250,000 for the next 12 years. Assuming we don't invest it, we stick it under the mattress, we're completely ignorant about investing and earning a return on our money on all three of these refi till you die cycles. Now, in reality, we would have invested those. In reality, we would have had some positive cash flow. In reality, we would have had some tax benefits from this portfolio and a whole bunch of other benefits. It's multidimensional, beautiful thing, but I'm only teaching you one dimension, which is appreciation on the refi till you die strategy. Okay, so we do have, like Dave, I've tried to follow in his footsteps. I have a little software company myself. It doesn't do what Mortgage Coach does in any means. It's completely different. But what it is for analyzing investment properties and also tracking those properties through the life of their ownership. It's called Real Estate Tools. And we have apps in the iPhone App Store and for iPhone and iPad. No, we do not have Android. Sorry about that, Android users. We'll get to that. And then we also have a SaaS web-based product called Property Tracker. So check that out if you want some help with these analyses, and also podcast and YouTube channel for more detail on this. And Dave, do you have some questions? Does anybody watching have questions? Happy to answer them.
So guys, any questions you have, let's bring them into the conversation. Thank you, Jason, for getting us all to look at real estate a little differently and talking about strategies that help people build wealth with real estate with your refi till you die strategy. Mortgage Coach community, I highly recommend that you connect with Jason and all the channels that he does business. The two primary channels are his podcast and his YouTube channel. I have a passion for YouTube channels. As you guys know, the Mortgage Coach YouTube channel is something that we add a video to just about every day of the week. But we bring in content to help you be the most successful loan officer you can be, the most successful mortgage advisor you can be. And Jason is all about helping you invest in real estate. Hey, Jason, I'm looking at your YouTube channel. I just shared it on my screen. Are there any, when you think of the videos you've added, I've got it sorted right now by newest.
Right.
Are there any particular videos that you think, like, guys, if you're going to watch one video I've done in the last month or two, watch this on your YouTube channel?
Actually, and I think it's on the channel, but I don't know for sure. There is a video that in 27 minutes for free, you can learn how to be a great investor. And it's on the front page of my website at jasonhartman.com. That is the one video I would pick, because what I do on that video, Dave, is I go through a pro forma on a property. And it's a real life example. I analyze every single number on that.
Is this the one right here? This one?
Let me look at it. Yes, right there. How to analyze a real estate investment. And I kind of interweave in that short 27 minutes, you know, some of these concepts we talked about today a little bit, but I really go through every number on analyzing a deal and an investment. And I think that is the one video. If I had to pick a video, that'd be the one.
All right, cool. It looks like you do need to put in your name and your email.
Yep.
But the thing I love about Jason, guys, he's all about education first. He will make sure you're educated, make sure you get it.
Yeah. And by the
So
way, Dave, you know, that's really what your whole system is about, and your followers that are using your software, because you know, when we educate our clients, we become their advocate, and they view us differently. They view us as someone who really becomes their ally, their advocate on their customer journey, and so that's really the way to go. It's very, very powerful, and you really just want to use all these tools, and you know, it starts with you becoming educated in this stuff, and then just translating that education to other people, so that you can really have those clients for life.
I love it, man. Well, I'm all about education. I'm all about helping and empowering mortgage professionals to be the smartest loan officer in America, to be the most valuable loan officer. So, guys, Jason is a tremendous educator. He is a tremendous resource. If anybody in the mortgage coach community is either an investor with Jason or you've referred people to him, let us know down below. We did get a question from Phyllis. Can you see that in Zoom chat? Do you see the question from Phyllis?
Oh, I can find it. Yeah, here we go. Okay, so Phyllis.
Remember, guys,
So
questions down below, whether you're on Facebook or Zoom, and we will have plenty of
I've
time to
always
answer
thought
those.
that, oh yeah, Phyllis, this is good. Phyllis, thank you for this question. I've always thought that the workforce housing is where you would have the best opportunity for stable rentals. I couldn't agree with you more. But with COVID-19, I'm looking for a workforce that works for the government or essential workers. You can't advertise that. Yeah, you know, I mean, look, workforce housing, which, you know, means like your B minus C class properties usually, are definitely good. But in any, you know, in any set of properties, you're going to have a mix of people. You know, some of those people may be affected, where they might have been in the service industry or the travel industry, and they may have lost their job. I mean, look, at nothing is perfect, Phyllis, no question about that. But generally speaking, in any area, you want to be below that median price. Okay, so take for example Indianapolis or Jacksonville. These are two great markets that we really like right now. Okay, and we're doing a lot of business in them. Memphis has been this sort of like consistently great market for us too. Okay, and you want to be below the median price in that given market, because when things get bad as they are now, and I mean it's uneven, it's certainly uneven, but you'll catch people moving down the socioeconomic ladder. Okay, that maybe get foreclosed on, or they had a bigger house that they were renting and they moved into a smaller house or a house that was less expensive. And what we talked about last time I was on this group is how there's this mass migration that is beginning, where people are just leaving cities like crazy. And you know, all of our markets that we've been recommending over the last 16 years are suburban markets. So suburbia is where it's at right now, because people want to be able to socially distance. They want to have larger houses. The home is the center of the universe. They want to have a home where they have room for a home office, where they're not in a place where they've got to take an elevator. The two biggest danger zones are elevators and mass transit. Okay, and those are what typifies any big city. Now, add to the COVID thing, add civil unrest, and you know, this terrible civil unrest that's going on. And you know, I don't know, are we in a race war? Let's hope not. I mean, this is really tragic what we see going on around the country and really around the world. But you know what? it mostly affects people that live in high density cities. So stay away from those areas. Those are not places you'd want to be investing or living for that matter.
So let's talk about what's happening, because we talked about a little bit in the meeting with you last time. It's a big topic in our community where loan officers are partnering with realtors to do either a Zoom or a Facebook Live event for that realtor's customer base, where they're both
Right.
bringing people to it, and they're having a conversation about moving up, moving down, and just call it reconfiguring your life and reconfiguring how you build wealth with real estate. So Jason, I know you are a specialist and you're always going to be advocating, hey, buy, income property. But I want you to kind of come to it from a different angle, that you're mentoring loan officers and you're mentoring realtors where 90% of their transactions are not income properties, they're
Sure.
residential properties. If I literally parachuted you into a webinar an hour from now and said, hey, Jason, we've got a bunch of families, don't make your pitch for investing in real estate, even though we want to enlighten them a little bit about that. But we just wanted to guide a conversation on, should you move up? Should you move down? How you can go about reconfiguring your life? What stats would you share? What would be the way you would drive that conversation?
Well, first off, I think as mortgage professionals, we should all be teaching our clients to invest in income property. Okay. Yes, you do the transaction on their personal residence and you know their finances from doing that transaction, and you know they're investing somewhere. They've got that stupid account at Merrill Lynch or Charles Schwab or whatever. How many people got rich following that plan? Only the insiders. Okay. That's who gets rich on Wall Street. There's this old story in that famous book, A Random Walk Down Wall Street, where the Wall Street broker takes his friend to see his beautiful new yacht, and he takes him down to the marina and shows him his gorgeous new yacht and says, that's my yacht and that's my buddy's yacht. He works at Smith Barney, he works at Charles Schwab, whatever, right, at all these companies, and then his friend says to him, where are all the customers' yachts? It's a good question. It's an insider's game. So we should teach our people how to invest in income property, number one, because they're investing somewhere. And hey, if they're investing in income property, maybe you can help them do more mortgages and make more money for yourself too. But as far as their own personal residence, okay, because that's the question you asked, so I do want to answer that. People are moving to more suburban markets where there's a lower density style of living, and they're moving to larger homes. Just think of this, okay? Think of a family of four, 2 adults, 2 kids, right? Now, you've got these 2 adults, say they were both working adults. They're hopefully, if they can work at home, and a lot of people can with technology, they're now both working at home. They're not leaving during the day. So they're now both working at home. And guess what? The schools have closed and the kids are now at home too. So they're studying at home and they're doing school online. And maybe there's an older kid in the family. Maybe they have 3 kids in this example. There's an older kid in the family, and they moved to New York City to go work as a waiter and act on Broadway or whatever, right? They moved home. Okay, suddenly, instead of needing a smaller home, people need a bigger home. Okay, and guess what? The gym is closed, or they're afraid to go to the gym, so they want to have an extra room for a home gym. Okay, and they got to have a couple extra home offices. So the home is going to get larger. People need larger homes, and the home is where people are spending their time. They're going to be improving their homes. They're going to be moving up. I mean, look, not going to be, this is already happening. Since the lockdowns lifted just recently, I mean, people are moving up. We're witnessing this mass migration. It's like the 2020 version of John Steinbeck's old novel, The Grapes of Wrath. I mean, there is a mass migration out of high density living environments right now. It's already underway, but it's going to be far more significant. And you know, we talked about some of this the last time you had me on.
Let's remind people, because I remember one thing that kind of blew my mind, and you had some numbers around it. The number of families, and guys, here's where I think this is valuable. When you're meeting with realtors, you know, to be able to talk to them about how can they benefit from families in their local markets reconfiguring their lifestyles to move there. And for those of you that are in those ideal suburban markets, how can you help your agents, and how can you guys be the ones that have the smartest conversation for the folks that want to leave? So would you give us those stats? I can't remember.
Yeah.
You talked about, you know, people that were roommates that were in non-romantic
Okay.
relationships. And
I got it. I got it right here. Yeah, got it
yeah,
right
remind
here.
us, everybody, on those stats, because I found
Even
them just
people who are in
mind-boggling.
romantic relationships are finding those relationships aren't always romantic. So anyway, roommates. Now the latest stats I have, it's a little hard to find stats on roommates, just so you know, are as of 2012, okay, and it varies by city, okay. By 2012, 32% were roommates, non-romantic roommates, okay, platonic roommates. So that's pretty interesting. But I think the bigger, more interesting stat is this one, Dave, and that was the stat about people living in mid-rise and high-rise apartments. Okay, now this is, keep in mind that the numbers I'm about to share with you are only apartments. They're not condos. Okay, so condos increase this number and make it even bigger. Okay, I'm only sharing apartments right now. Okay, so this is according to Yardi Matrix. There are mid-rise apartment buildings are anything 5 stories to 12 stories, and high-rise is above 12 stories, okay? So the number of units that are high-rise apartments are 953,000, well, over that, but I'll just round off. It's actually 954,000 rental units in high-rise apartments in the US. Mid-rise, there's 1,316,000, okay? So rounding off, just call it 2.3 million units in mid and high-rise units. Now, if only 15% of those people want to move, only 15% are concerned about getting in an elevator, and they're probably living, if they're living in a mid-rise or a high-rise, they're probably living in a high-density environment altogether, where they're probably taking mass transit a lot. So if only 15% of those want to move, that's 340,000 units, okay? If you spread that among 50 suburban markets, which it would probably spread even to a smaller number than that, that means you've got about 6,800 houses needed in addition to what is already a market with a massive housing shortage that has been going on for many, many years, okay? So Phyllis asked another question. She said, Jason, this migration is temporary and it affects different age groups. I live in DC, where we have a massive migration into DC of young people. There are 8 to 10 contracts per listing. Well, Phyllis, I agree with that, but are you talking about something that was going on a few months ago, or are you talking about what's happening today? And I would also say that DC is a little bit different, because DC is the bailout capital of the world. It's where all the government money is. Okay, and DC does have a little bit. DC is not New York. Okay, I interviewed Dottie Herman on my podcast recently. She is the CEO of Douglas Elliman Real Estate, a big New York real estate brokerage. And she says, and by the way, what's interesting about her is she was so honest. She was so candid, because she was saying a lot of stuff. And you can just go listen to the episode. It's, you know, uncut. Just go hear it for yourself. she was saying a lot of stuff that was very much against her own self-interest. Okay, her self-interest is to promote New York City because that's where the bulk of her business is. Okay, for Douglas Elliman. Now they have, some offices outside of New York City, but big bulk of their businesses in the city. And she was talking about how people are just flooding out of New York City. Okay. And this is not just true of New York City, it's any downtown area. So in micro areas, you don't consider San Diego to be a city, right? But downtown San Diego is. It's very dense in downtown San Diego, in downtown LA, even though it's sprawling at the same time. So I'm just saying high rises and mid rises. And by the way, Washington, D.C. does not allow high rises. So, that's another thing unique about D.C. So it is a little bit unique. But also you've got, some of the effects of the Amazon effect and so forth. So every market is very unique. I'm just talking about a macro trend that people are concerned about living in high density environments. They don't want to be in elevators. They don't want to take mass transit. And once they get past those two things, they don't really want to be on crowded streets. They don't want to be waiting in line. I mean, I have friends that live in Brooklyn, New York, for example. That's not real high density. I mean, everything's low rise. You're not usually taking an elevator when you live in Brooklyn. But when you go to the store, and these old stores have narrow aisles and you can't, shop. Like I live in Palm Beach, Florida now. Okay. I go into the store and they've got big wide aisles and it's very, like I'm not concerned at all. I don't wear a mask or anything. Okay. But try going to the grocery store in Brooklyn. You can't socially distance. It's impossible. And this is stuff that people are concerned about, not to mention add the riots to this whole thing. After we, forget about cerveza sickness, as some people call it, let's talk about civil unrest. Okay, it's all in the high density areas where the biggest concerns about that exist.
So guys, and there's other micro trends. I mean, there are macro trends. Autonomous cars are coming, and what is that going to mean? Internet is growing. Grandma knows what Zoom is. And there will be more virtual workers than ever. I mean, look at the stats of Zoom. So
and Dave, none of these technologies are really that new. I mean, 20 years ago we could have used WebEx or Skype 17 years ago,
but they're
right?
prevalent
But now they're
prevalent.
adopted. Grandma is using Zoom. It's a miracle, right? Because it's necessity. Yeah.
Yeah. So the takeaways for everybody as we wrap up today's call is master being a virtual worker. And if you're a mortgage professional, that means not only do you need to have great one-on-one conversations with people using video, using Zoom, using Facebook Live, you need to have great one-to-many. It's one of the reasons why I've been bringing in experts to talk about data and insights. And I'm also bringing in experts like, how do we create a wow experience in Zoom? I'm going to be bringing in Rene Rodriguez and his audio visual guy tomorrow. And we're just going to be talking about, how important audio is, different ways of upgrading your lighting and your camera so that you can create wow, and you can do that. And then, the takeaway for everybody is just learn, be a master of building wealth with real estate, personally and professionally. And in the markets that you serve, if you are in one of those markets where people might be migrating out of that, be a leader. Don't get your news from the news. Create the news, know your data, follow Jason, understand his macro trends, understand those markets, and be the one who is helping families make an informed decision based off of their personal goals and based off of their localized real estate realities. So be the one that's helping people make those decisions. So Jason, we are almost at the top of the hour, wrapping this up. Any last words of wisdom you want to share? Anything you want to close out today's call with?
Just thank you for having me. It is a crazy time right now. Know your stuff, become your client's best advocate, become their educator, impart good information to them. Check out my podcast and YouTube channel for more. Websites, jasonhartman.com. And just everybody stay well, be safe, and happy investing.
I love that. And And I want to close out the last words with, I love this refi till you die strategy, but I hope the takeaway isn't go sell this strategy to everybody. Help people make informed decisions. Be the one that can help visualize those decisions. Use a total cost analysis when it comes to helping a family with their principal residence, whether that's buy a house, sell a house, refinance a house, and follow Jason. And when it comes to investing in investment properties, check out his software. Watch the video that he told you guys to watch. So have a good one. Jason, you the man, bro. Appreciate you.
All right.
Little virtual
Thanks, everybody. Fist bump.
Take
Yeah,
care,
virtual
everybody.
fist bump. Bye,
Give us
everybody.
a like down below. Share this with your team. Take care.
See ya.